Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to talk about Canada's housing bubble. Of course, you know I love context, so we're going to quickly explain how we got here and then shift gears to what's going on with house prices and then touch on some of the shenanigans we are seeing with banks and developers as we enter in the next stage of this housing market. Like most economic phenomenon, housing bubbles can have many triggers. However, over the last 20 years or so, there's been a common theme, and that is interest rates. Whether you look at the US, Spain, Ireland, Australia, New Zealand, the UK, and most recently Germany, when interest rates are held too low for too long relative to an economic growth potential or inflation, money will naturally flow into long-duration assets in order to take advantage of the outsized leverage banks are willing to offer home buyers, who often then make huge profits, often tax-free, fueling speculation, which becomes a vicious circle. This is exactly what happened in Canada. Coming out of the global financial crisis, Canada's recession was shallower and its recovery was stronger. And yet, Mark Carney, the Bank of Canada governor at the time, kept interest rates well below core inflation for nearly 4 years, long after Canada had normalized. This long period of negative real interest rates led to an enormous misallocation of capital, specifically in the residential real estate market, i.e., a huge housing bubble. By now, you guys know that I like to stress that it's never just one thing, and most Canadians are very familiar with the bottlenecks around permitting, zoning, and the environmental lobbies, as well as the NIMBYs that all work to restrict supply. However, what really sent housing and rental markets to the stratosphere was record population growth, which was entirely driven by immigration. This jump in demographic demand massively outstripped housing starts, which led to a record supply deficit. The cumulative result of the local and federal policy missteps and the speculative fervor for which Canadians themselves are to blame trebled house prices while incomes, as I'm sure you know, lagged. One of the questions we need to ask ourselves now is, are we still in a housing bubble? And in my view, the answer is yes. But the mistake we often make is treating several wildly different markets as one homogeneous blob. This chart from the real estate research group Demographia highlights the problem we have. There's a big difference between the GTA, where house prices are 9 times the median income, and Edmonton, where it's just 3.6 times. But let's be clear. The median multiples in BC and the GTA and the Greater Golden Horseshoe area are absolutely nuts. And according to Demographia, Toronto and Vancouver remain impossibly unaffordable. Comparing Canada to other countries is another easy cross-check. This time it's the OECD's house price to income ratios relative to the country's long-term average. And once again, the answer is clear. House prices are still in bubble territory. The obvious counter that I often hear is that house prices have moderated, and indeed that's true. But as you can see from the chart, we're only just off our blow-off top and well above 2019 levels. Another criticism is that Toronto dominates house price indexes and thus does not allow for the granularity with respect to other cities. And that's fair. However, breaking down affordability by major metros, and you can see the story doesn't change and corroborates what we saw from Demographia. Even cheaper cities like Montreal and Calgary are still as unaffordable as they have ever been. And this is after record rate cuts from the BOC. The final way to confirm that Canada is still in a housing bubble is to compare house prices to rent, the red line. And here again, we see that prices are still well above historical norms, although there has been a slight correction. So if we agree we're in a bubble, what stage are we in? And indeed, that's the million-dollar question. Each asset bubble varies in specifics, but the stages are commonly observed in historical bubbles, such as the Tulip Mania, the South Sea Bubble, the dot-com bubble, etc. The stages are outlined in the stylized chart on the left, and they roughly map onto the list you see on the right. Personally, I'd say we're somewhere in between stage 3 and stage 4. There are clear signs of trouble, but one can't deny that the recent rate cuts have breathed new life into a few markets. And then there's the growing evidence of accounting tricks and deceptive lending practices that are coming to light. One of the more dubious things going on is something called blanket appraisals, where incomes and, more importantly, asset values are collectively underwritten. This accounting witchcraft has been around for decades, normally used for single homes quickly built in a subdivision. But now in Toronto, for example, where condo prices are down 10 to 30%, banks and developers are increasingly relying on blanket appraisals to prevent buyers from walking away from their deposits by securing financing at much higher valuations, real or not. To be clear, this is not fraud or even illegal, but neither were the shenanigans around mortgage-backed securities that led to the housing crash in the United States. Take it for what you will. All right, that's a wrap on this week's episode. Thanks very much for watching. Please like, subscribe, and follow for more. And as always, we manage money for families across Canada and the world, so please feel free to get in touch.